So, let's jump right into this. The end of last week, President Trump came out and finally gave us his new Fed nomination. A guy named Kevin Warsh, who has some knowledge of what's going on in the Fed and has worked with there before. And I just wanted to get your some of your opinions on that, as that seems to be something that seems to be leading a lot of the conversations. Rob, you want to start?
Sure. While these things don't directly affect our portfolio management, it's obviously something that's talked about pretty widely in the news and affects monetary policy and economic growth and such. So it is worth at least considering, or at least thinking through it on our end. From our standpoint, given given the president's history of nominations, this one is what I would say fairly qualified and fairly conservative. I was pleasantly surprised at the level of experience that he decided to go with. As you mentioned, Warsh has been on the Fed Board of Governors before. He has extensive background in Wall Street. He's pretty widely well known guy with a lot of experience, and frankly, from policy standpoint, he's probably about the most hawkish that we could have expected, given the president's you know sort of apathy for Powell and his general calling for more monetary easing. And historically speaking, Warsh is known as a more of a hawk when it comes to the balance sheet. He might be a little bit more dovish when it comes to interest rates, but from our standpoint, the balance sheet is far more important than what the short term interest rates are. And so, all in all, from an economic standpoint and from our policy standpoint, he's a pretty qualified and fairly conservative choice, which I think the markets should like. Alex?
Yeah, I'll agree with you there. I think you said it very well. We were kind of, we discussed it a little bit yesterday in the office here, and it was kind of a pleasant surprise from the level of experience, given some of the other, nominees that he's put up in other areas of his administration. This was kind of an upside surprise on that. The question, yeah, is are you getting kind of hawk or dove Warsh when it comes to policy? But I think he's got good experience, he's got track record, he's got a decent head on his shoulders. So I think this is also nice from a kind of concern about the independence of the Fed standpoint as well. Where if he was an inflation hawk, and he still is, he's not going to kind of bow to Trump's demands for lower rates. So yeah, from our standpoint, this was probably one of the better picks he could have made. Kind of regardless of where you stand on his policy, but his experience is good, and I think he'll be pretty level-headed in there.
And perhaps could solve some of the bifurcation within the Fed, in some ways kowtowing, or not kowtowing, but accommodating both the president and the public's call for lower short-term interest rates, but meanwhile remaining hawkish on the balance sheet.
Yeah.
We could kind of get a little bit of the best of both sides within there.
And that balance sheet is very important, as you said.
And Jerry, I know you guys don't always consider things like this when making your decisions, but I'm sure it's been talked about around the water cooler some.
No, it hasn't.
Okay, fair enough.
You're spot on there with how we think, Rob. I mean, when I'm out talking with the advisors who use our fund, I often talk about how this business is filled with geniuses. 200 and some thousand CFAs, CPAs, MBAs, PhDs, and a lot of time and energy gets wasted on this stuff, in my opinion. Yeah, I think I would agree with, in general, with the comments both of you have made. He's well qualified, but all of them were. It remains to be seen, I think. his past is different than some of his present. So I just think we have to wait and see. In the meantime, I remain focused on the stuff that I always have been, is trying to find value-oriented bonds. Today I picked up a few million of a bond traded 150 cheap because it's only $90 million outstanding, and so I got a great illiquidity premium on it, and that's how I've tended to win over the long term. We'll pay attention to the first couple of meetings, and I think we'll get a good sense from that of where the present Walsh is on the policy issues that the market will care about.
Well, and it's safe to say that's one of the reasons we've partnered together, because we appreciate your approach and how it is different than our approach, and the value that your decision making adds, right?
Well,
We don't all look at this through the same lens, and I think that's part of what makes MMP work.
I like to cite that. Now it's getting to be a little bit aged, but study that shows that the professionals on their interest rate forecasting are only right 47% of the time. I tell advisors we can go out on the street and ask the next pedestrian for their interest rate opinion, and they're as likely to be right. So again, I know it's important, and I don't mean to be too dismissive, but I think in general we've got to wait and see with this guy.
Well, let's talk about the past here just for a little bit. We're doing this basically at the beginning of February. We're just into 2026. Markets seem to have a really nice run in 2025. I want to get all of your opinions on how you think the market ended, and the fact that so far this year we seem to have an expanding of the actual rally. We're seeing a lot of the sectors away from the Mag 7 actually starting to take off. Do we see this as a pattern that may continue for the rest of the year? So let's talk about how we ended last year and where we see things going.
Yeah, I can start that one off. I think for us, our base case is kind of 7-8% return on the S&P, which is pretty in line with historical average. The nice thing is it's being driven by earnings, or supported by earnings, which have continued to be solid. Seeing the broadening out has been nice after 23 and 24, where you saw the Mag 7 just super concentrated, driving the market higher. Seeing a broadening out in that in the other areas has been really nice, and I think that's supportive for markets in general. I think the international space, is also poised to have some good performance. I'm not sure that I don't think it'll 2x the S&P like it did last year, but I think certainly it's warrants staying diversified, and we get clients calling in and worried if they've missed the move in international. For us, the short answer is no. There's a couple of reasons behind that, but it's for us, it's still a place to be as well. I think we're looking for kind of a more muted year. With the midterms, you get a little bit of volatility heading into September, October ahead of the elections. And then once markets know what they're dealing with, you get that typical post-election seasonality where things move higher once they have things sorted out, or once they have the election results sorted out. But for us, we're kind of staying the course right now. A year ago, tariffs were just starting to come into the kind of lexicon. And so at some point, we'll probably be down between 10 and 15%. And we'll see what it is at that point. But for us right now, the kind of, there aren't any really obvious potholes. But, maybe you say that afterwards when you have a flat tire and you're pulled over on the side of the road looking back at it. So we're kind of just staying the course for now and enjoying the broadening out of the market.
My take on the fixed income world is that, we were pretty much range bound most of last year. And I really don't think there's going to be a whole lot of change from that this year. As was just noted, there can be disruptive events that'll be hiccups that, could cause either a spike up in rates or some drop in them. But for the most part, I expect the year to be, but when we're done at the end of 26, we'll look at where rates were. I'm referencing the 10-year Treasury, but I think we're going to kind of, say ho hum to it. What I am paying particular attention to is credit risk right now. We're not seeing that emerge in spreads yet in the high yield world, but if you've been an investor in the BDCs, you're seeing some real severe stress going on in stock prices, and we just had a recent huge 19% markdown on one BDCs. That's business development companies, NAV, and so I think we've got to take credit risk seriously, and spreads on high yield are way too narrow if we're going to start seeing a surge in bankruptcies. So I think the BDCs may be the canary in the mine for us on credit risk. So I would advise people to be fairly mindful of spread widening risks.
From a fixed income standpoint, as you know, we're not known as primarily as a fixed income shop, and so, like Jerry said, we've been fairly conservative in our credit risk and fairly short in our duration, owning short-term govies to mid-term govies predominantly. From an equity standpoint, the narrow leadership of 23 and 24 and the Mag 7 was not good for diversified portfolios, and particularly difficult for our portfolio management style. This broadening out of the market, where we've seen some rallies in the small and mid cap space and some strength permeating through other sectors, has been very good for our portfolio performance. And again, I think that goes back to the whole purpose or the whole idea behind the multi-market portfolios, is that when one of our strategies does extraordinarily well, it buoys the other ones and vice versa. So it's that combination of looking at things differently that sort of smooths the ride for our clients. And thus far, we've been very successful in doing that with some of the equity pieces on the other portfolios and the fixed income pieces helping us when we were lagging by a couple of percent. And this year we're leading by a couple of percent and helping to cover up some of the more narrowly focused portfolios. So, it's been a successful venture, and I think that this collection of managers is not only easy for us to work with because they're all accessible and like-minded in their business, but also we like them because they provide a different perspective than what we have, and that's, I think, smooths the ride for our clients.
Well, with that being said, I'm going to hold you all to your numbers, and when we talk again next quarter, we're going to update it again. I appreciate the three of you taking a little time to talk to us about where you see the markets, how this MMP portfolio works together. And, if you have any interest, you can always go to our website, www.multimarketportfolios.com. With that, I thank you for spending a little time with us, and we'll talk to you again next quarter. Have a great day.
Thanks, guys.
Thank you.